Well, welcome to another one of Steve's Stock Stories, and I'm here again with Greg Carroll. If you didn't see the previous one we did something on bond risk. Well, today we're going to talk a little bit more about concentrated stock risk. And Greg Carroll and I, Steve Wolff, have been together for a long time, since 1994. There was a little hiatus in between where he went and started his own company and then came back to our company. So love having Greg here.
It's good to be here, Steve.
All right, before we get into the concentrated stock risk, just remember that this is for informational purposes only, and it's not meant to be for specific advice for anyone. So, don't buy something based on what you hear today or sell something. Make sure you talk to your financial advisor or your tax advisor, whoever that person might be. All right, now we got the legal stuff out of the way. So, there's a story that you were talking about a company called Applied Microcircuits. I don't know when this was, but why don't you give the background on it and talk about this concentrated risk position?
Yeah, so this was back in 1999. We started working with this company, a publicly traded company that was local here to San Diego, and it was during a time when a lot of technology stocks, not a whole lot unlike today, where they seem to be going up all the time. And this particular company, we worked with their employees on their stock option plan and their 401k. And if you're familiar with stock option plans, when employees, back then they gave a lot more stock options out to every level of employees. I think a lot more than they do today. Probably had to do with some of the over-concentrated positions back then.
Hey, I'm sorry, when was this?
This was, we started working with them, I believe, in 98 or 99.
All right, but that's when the market, especially for tech stocks, was going crazy.
Exactly. And so, when things started blowing up in, late 01, 02, we had a lot of their clients, a lot of their employees, that we were working with on their individual plans. And one of the things we were trying to do, because their stock went from like $2 up to $200. So the lowest level employees, had near $1 million in stock, the lowest level employee. And we were working very hard to try and get these employees to diversify some of that stock into a more diversified portfolio, or maybe a tax-free bond portfolio to replace their income, just in case they weren't able to work or the company went away. But the employees would be telling us, why would I sell it? It's going straight up.
And so we all know that stocks only go up, right?
They only go up until they don't. And, and especially when it's your company and you have a lot of stock, and everybody's probably looking at their phones, the computers, and seeing how much more they're worth today than they were yesterday. So we struggled to get these employees to diversify. I had one of these clients, one of the employees there, who was buying a house. His mortgage was $10,000 a month. His salary was $125. I'm like, it doesn't make sense. They just couldn't see the forest through the trees. And so, a few of the employees listened to us, but not nearly enough, because what goes up can come down. And eventually, AMCC did go away. They ended up going bankrupt or were bought out for pennies on the dollar by another firm.
So the moral here is that all those people who had this huge concentrated risk, where I'm betting that, especially when you're talking about the bottom of the totem pole there, they probably had 90 to 95% of their net worth in that one stock.
Absolutely.
Yeah, so basically, well, what happened, for instance, do you remember what happened to the guy who had a $10,000 a month mortgage on $125,000 income?
I do not know. He was also apparently really into music, and he was flying to Denver. Apparently, they make very expensive speakers out there somewhere. Mm-hmm. I mean, these were $10,000 a box. He was buying for his home stereo. So there was a lot of...
I'm sure he's heard of the funeral march, that music.
Yeah. I do not know what happened to him. That was a long time ago, and a lot of these, people just didn't have any money left.
Yeah, it's interesting because when we get people in, and being a CFP, that in the planning process, you go through and you look to see if there are some blind spots that people have in their plan.
Absolutely.
And having a concentrated portfolio, I mean, it can be great. I mean, anyone who's had Apple or Microsoft or whatever over the years,
Right.
you know, in their stock option plan, whatever it is, you know, and they may have a high concentration, it's done fine.
Yes.
But you never know when that day comes when the other shoe falls. And that's really the problem. So going to financial planning, what we always say is that, you know, you don't want, especially when you're retired, you don't want to have that much stock or that much concentration in any one thing, because if something bad happens to that, then what? What do you do? I know I had a client who was very concentrated in Raytheon. And it was at a time when Raytheon stock was doing really well. And, you know, he was happy as a lark, but he wouldn't sell it. Just wouldn't sell it. I said, but, you know, you've already made the money. You know, let's diversify it. No, he wouldn't do it. And, of course, that was a time when Raytheon stock just got hammered.
Sure.
And now what? You know, you're in retirement, and how do you make it up? You don't.
Right.
Okay. So, and then there are a million examples like this.
Yeah, we've as long as we've been in the business, we've got a lot of stories similar to that. But the AMCC story was a broad-based. I've never seen so many people not listen to good financial advice about diversification. They were very, you know, they were just in the euphoria of that stock going up. And I mean,
Right.
you know, if you're making, you know, $30,000-$40,000 cleaning the facility, and you got $500 to $1 million in stock, I mean, you just aren't used to what that wealth is and how to handle that. So it was unfortunate that they wouldn't take advantage of it.
And each person has a specific need and a specific want,
Yes.
and that type of thing. And for some people, you know, I mean, if you're worth a lot of money and you have outside of that one position and you have a concentrated position, it's not as devastating if something happens, as opposed to a lot of the people who really literally had 90 to 95% of their net worth just all in
Right.
one company. It's a dangerous place to be, especially when you're going to retire
Right.
or you're close to retirement.
Yeah, and you know, along that line, a lot of, you know, retirement plans aren't allowed to allow their employees to put everything into the company stock in the 401ks anymore. They're much more limited.
Didn't that change, though, after the '08 debacle?
That was a catalyst. With Enron was the biggest one, because they were actually promoting their stock to the employees.
Right. Well, you know, and we've worked for companies that they promoted it to us. You
Yeah.
know, that, hey, this is a great thing. Don't you want all of your money in this? You know, you got to buy the company. And if you didn't buy it, you felt guilty.
Oh, yeah.
They made you feel guilty. Mm-hmm. You know, so for those people out there who are working for some of these companies, it's okay to take some off the table. You know, there are other businesses out there that do very well, you know, and they're not probably not all going to go out of business at the same time.
Right.
You know, and, you know, especially if they're not in the same industry.
Correct. Yep. Diversify across the industries,
Right.
as well as.
And it could be for some people that not only diversify, you could diversify into other stocks, you may want to diversify into bonds, you may want to diversify into alternative investments or real estate or whatever it might be. And by the way, I think that goes for, especially where we live in California, you know, everyone believes that real estate never goes down. All right, well, I was kind of hoping that the '07, '08 debacle that we had would have taught people that even real estate can go down. The
Yes.
funny part of it is, though, that it always comes back up, but so do stocks, but not necessarily in individual stocks.
Right.
An individual stock. Now, I can't guarantee that every single time that this is going to happen, the stocks, you know, that the stock market's going to come back, but it has 100% of the time in the past. So I feel pretty good about thinking that in the future that's still going to happen.
In the long run, it's usually pretty good, yes.
Right. So concentrated risk, not such a great thing.
No, no.
You know, and again, two sides to that. If you were a secretary at Microsoft back in 1987 or 88 or whenever it was that it came public, and you were smart, and, you know, after the 20 years or 25 years or whatever it was, and you became very, very wealthy. But then you took that, and aren't there ways that, I don't know if you know this, but aren't there ways to offset that or to off-put the concentrated risk? There are certain investments you can make.
There's exchange funds. If you have a large, you know, company stock, like a Microsoft or an Apple, that you can actually take large positions that you might have a very low cost basis, and you don't want to pay capital gains, but you want to diversify. So how do you get rid of it? Put it into these exchange funds. And now you're diversifying with other people that had different stocks in a similar position, very low cost basis, big chunk of their net worth, and you pool that together, and you can avoid the capital gains from the diversification event that you just went through.
Right, and that's not to be confused with exchange-traded funds.
Correct.
These are exchange funds.
Exchange funds.
And they basically, do you know how that works?
Yeah, I believe they typically you need about 500,000 of a stock to put in there, and then you can't just exchange any company stock into these. They do have criteria that they look for so that they don't end up concentrated. If they took everybody with Microsoft stock, it wouldn't really do much good, right? So they do have rules and that they have to follow based on the fund's objectives.
So they're literally exchanging your stock for some other securities.
Right. So
Okay.
you don't pay the gains until you actually sell your shares of that fund, but you got the diversification without paying Uncle Sam.
So these are the types of things that you need especially if you're in the situation where you have a concentrated position. You need to talk to your financial advisor. You need to talk to your tax person because there's some pretty good sized ramifications for not doing it the right way.
Correct.
So, at any rate, so that kind of brings us to the end of another Steve Stock story. Greg Carroll, we thank you very much for being here,
Thank you.
and we'll see everybody next time.